this ETF does something very interesting. It gives you exposure to the S&P 500, but it also gives you plunge protection. First off, read this disclaimer carefully. PHDG is the ticker. Invesco S&P 500 Downside Hedged ETF. First, we will look at the charts, and then we will look, in more detail at how this ETF enables you to sleep more comfortably during these very erratic markets. Here is the charts. We are using weekly data points, so we have data all the way here back 2014. One of the very interesting observations here is the recent plunge that we saw in the S&P 500. Let's get the SPI ETF up here, like that. So you can see that during this plunge right here, the ETF, it spiked. It spiked actually quite dramatically. We certainly see the hedged mechanism kicking in here in a big way. If we look at some of the previous, pullbacks in the S&P, like here and here, then the performance of this ETF, PHDG, is not impressive. It is basically tracking the market. But during sharp spikes in the VIX, that's when we see it really shine. And a spike in the VIX is that happens when there is more of a surprise event that is fraught with such uncertainties that people will just flee into the options derivatives markets, which VIX reflects. Yep, here we have this ETF. It is a way to get that downside protection. Let's look at the S&P 500. So here we have the S&P 500 without any protection whatsoever. And we have seen a rather substantial rally. Let's measure the rally from, let's do it from there to here. That is a 21% gain. We are heading into some key resistance levels. This is a resistance level, the 10-week moving average. If we go here to daily data points, you can see that we have the green 50-day moving average forming a resistance level. The 5-day moving average here in blue is the support level. Hence, we are at a very critical juncture, resistance and support. The RSI is in the neutral zone. The volatility reflected with the average true range, it's gradually been pulling back. Let's actually also do some Fibonacci retracement. If we measure from this high all the way to this low, we are above the 50% Fib retracement. We were above there. So we broke above the 50% retracement. It is fully possible to still be in a bear market and go all the way up here to the 61.8 retracement. That also puts us in battle with the red 200-day moving average. As long as we stay below the 200-day, and for all intents and purposes the 200-day staying negative, you could make the case that we are in a bear market, notwithstanding this rally. We measure from this high to how far to breaking out, we would have to rally 19%, which is rather substantial. A key point is that the world economy here is radically different from the world economy back here. It would be rather absurd if we were to go up to these levels. The big caveat with that very rational analysis, that is the Fed factor. The Federal Reserve, they are pouring trillions into the economy. And the saying is that you should not bring a knife to a gunfight. And if you are going to play around with someone who can just in a blink of an eye create trillions of dollars, yeah, you gotta be very careful. So don't fight the Fed. But for all intents and purposes, I am still a normative bear. Whether I want to act as a bear, that is something you got to evaluate on a case-by-case basis. If you do, however, want downside plunge protection and still have exposure to the S&P 500, this ETF is one of the ways to do it. It's a simple way to do it. There are better ways, but they are much more complicated. And then I am talking about the options market and stuff like that. But here are some details. Expense ratio 0.39%. Assets under management $36 million US, 800,000 US dollars in average daily dollar volume. That's pretty decent. While S&P 500 stocks play a starring role in its portfolio, PHDG offers decidedly different exposure to US large caps. The fund aims to stave off the impact of huge market downturns by holding a security that often spikes when the S&P plummets, VIX futures. The challenge is that maintaining VIX futures exposure over time is terribly expensive. Still, if the market tanks, PHDG will likely outperform while lagging when markets behave more normally. When we look at the year-to-date performance of the PHDG ETF, it is up 3%, while the S&P 500 is down almost minus 14%. So yes, it does have an effect. Let's look at some basics here about bear markets. One of the first things is that bear markets are actually very common. And here you can get a grip on how powerful a bear market is, how it can really impact your overall portfolio. So if you do have $200,000 in your account, but you experience a minus 40% bear market, you will not break even until the next bull market rallies 67% from the lows. So minus 40%, but you need approaching almost the double to get to get back to even. This effect here is also why it is very powerful to buy low and sell high. Here you can see the math. And if, say, the market falls minus 70%, then it needs to rally a whopping 233% to just break even. Another key point, many markets that crashed never recovered. So think about the Roman Empire, the British Empire, ancient Greece. These markets, they had a bear market, and then the bear market got deeper and deeper until the entire society would never be the same. And just look at the British Empire. Imagine buying the dips all the way down the fall of the British Empire. I mean, you would never come back to even. So ask yourself the question, is your portfolio tied to single markets? How diversified are you? And given that most have insurance for their home and car, well, it makes a lot of sense to also have it for savings. Yeah, this is an incredibly critical juncture in the stock markets. especially the S&P 500. And yeah, it's a huge deal. We will soon know whether we will be able to get out of this this valley, or whether this will become a very long-term bear market. The bulls have done a lot, but the bulls are rallying on extremely good news for the bulls, okay? But it is very hard to see the Fed going even further. I mean, they have just ballooned the debt, because all of this money that's just been created, that's not something that should be taken lightly. And another key factor, given that the economy still is very unhealthy, there is a huge risk for social unrest, especially if we get a scenario when, with the S&P 500 and other stock market indexes, if they break out to new highs simultaneously as you have a very high unemployment rate, a broken economy, I mean, that will create incredible social unrest. And just imagine the antagonisms. It would be very dramatic. Hence, if we do break out to a new all-time high on the S&P, which I do think is highly unlikely in the foreseeable future, if it does happen, that would be incredibly bearish. But then we would have another risk factor, not the contagion, but then we would have social unrest, political radicalism. Whatever you do, of course, you want to let the trend be your friend.